All right, what's up, everyone? I'm in college right now, so I have a different scenery in the background than usual. Last time I was in my motel. Before that, I was in my Santa Monica apartment. But today, I wanted to just go through. I got a comment on my last video about talking about more the due diligence behind and stock value investing, finding the intrinsic value of businesses, of companies, and I wanted to talk a little bit more about that. I have a little checklist that I use, and this is what it looks like. I'll go through each point. It's a longer checklist, and it'll be a shorter video today, and in future videos I'll elaborate. But here are just a few things to keep in mind. So, stock valuation. So the number one thing that's very important is considering the quantitative and the qualitative. What I like to think of that is the quantitative are the numbers, financials, balance sheet, cash flow, income statement, things like that. And the qualitative are the words that tell you the story of what those numbers really mean. For instance, a qualitative could be the experience of the management, if they have worked up into the company or there's some, outside investor who came in or board of director who doesn't necessarily have bottom up experience through all levels of the company. And then, that will complement quantitative factors if it's an undervalued business. If it has good management in this example, then, you would pay a higher price for it, even though necessarily the PE ratio or whatever measurements you're using show that, you wouldn't pay the price solely based off that number. So I said, for example, be more conservative in your analysis for uncertain industries and companies. So that's another qualitative example. Uncertain industries can be streaming. It can be ones with ESG risks like oil. They can also be broadcasting services and things that cost a whole lot of capital to run, which you can measure quantitatively, of course. But overall, industries that don't necessarily have a clear vision of the future. And, in security analysis, the authors say that you don't want to base an investment on the future prospects of it. Like, you don't want to base the purchase of an investment on, a good set of future prospects. Rather, you base an investment on guarding against the future prospects. You're guarding against all the possible things that can go wrong. And so with uncertain industries, you want to avoid those for kind of the same reason that you would invest in a stock that's undervalued. I said Paramount is one example. I messed up with this stock a little while back because I kind of thought that the streaming platform would be more of like a predictable type of industry, but it turns out it is very uncertain profitability wise. And so they have, major programming charges that go into that business that are recurring and not necessarily good for the return on invested capital. So that's one example of a stock that has an uncertain industry, in my opinion. Look for investments, not speculation. So this is what I'm going to define between investment and speculation. Investment is something that guards against the future rather than depends on the positive occurrences in the future. So what that means is that you buy a stock that has what's called a margin of safety, and or that could be a bond or preferred stock as well. But overall, the margin of safety is going to give you some type of promise of satisfactory return, because if something goes wrong to the business or to the price in the short term itself, then you have that buffer to rely on and sleep well at night, knowing that your investment is still undervalued, that you still should hold it at its undervalued price. Speculation is, say, to go to a stock and only buy it because of its chart. Those people are called chartists who look at the bullish flags and the wedges and things like that. And what they're doing is they're just praying that people will purchase the stock at a higher price than they will. They're depending on the market to make their investment profitable. And that is not necessarily what we do, because in common stock investment, it is definitely speculation to a certain extent. The authors of security analysis uh, definitely assert that notion. They say with bonds, it can be a very different type of idea, because you have a fixed income that is a lot more assured, because you're junior when you're a common stockholder, you're junior to bondholders and preferred stockholders, and that is a very powerful um, piece of kind of a warranty when you have a stock investment, when you have an investment period. Um, Another kind of difference between investment and speculation is, let's say you're going to invest in a stock that has, this new product that's coming out, and you think it's going to revolutionize everything. The new space companies, or bioastronautics, or asteroid mining. Like, these go along the lines of uncertain industries that haven't necessarily shown a past performance of relative stability, and that is speculation, because it's the same idea that you're depending on the future success of that product or that entire industry to justify your stock purchase. And with an investment, it simply looks at the past performance and makes that as a very rough guide into the future. It sort of extrapolates to a very limited extent what the revenue, income, cash flow in the past will be, and then extrapolates that into the future. And the industry, the management, all those qualitative factors go into the question: is this business going to continue to generate cash flow 5, 10, 15 years in the future? Are they going to overcome competition? Are they going to continue to create revenue and keep revenue with growing or at least stable operating margins? So all those questions go into the idea that when you're investing in a business, and let's say you're buying its common stock, you are saying that the value of its cash flows into the future, discounted at X%, based off the current interest risk-free rate, that value is much, much, much higher than what it is today. That is kind of the definition of an undervalued investment from one perspective. You can identify between these by past performance and price. Price is another thing that, of course, makes something a speculative or investment issue. If you're running on a very slim margin of safety, where the price is very similar to where the business is intrinsically worth, then you're still operating on the notion that the business must grow in order for the value of your investment to grow, or the price that you purchase the stock to grow. So yeah, I think I'm going to end it off with that. It was a very quick video, but I want to continue to make these, so I hope you enjoyed. I'll see you in the next one. I'll talk more a little bit about due diligence. We'll get farther down the checklist than 4 lines. So